Hello, dear eTorians. This is PC here from GlobalAlphaS. I'm coming back to you with our usual monthly portfolio update. Sorry, this month it's a tiny little bit later than usually because of the holidays with my kids. But as soon as I can and I have access to the internet and the computer, I'm coming back to you with a monthly update. So let's just get down to business. I'll present my screen right now and we'll go to the appropriate details of what was up last month. Generally, the equities kept bleeding. That's the headline that I have put on my presentation. That was exactly the case. June was, again, a terrible month for equities in general, with the S&P being down over 8% and the Nasdaq 100 being down over 9% for the month. So again, a very bad month. A lot of volatility to the downside. Obviously, the growth stocks were again the ones that were killed the most. There's been some difference to the month before, in a way that I have seen some signs of some of the parts of the growth areas starting to look much better and behave much better than they used to for the last couple of months, but this is still like a light at the end of the tunnel yet. Rather than a big change of trend for that to happen, we would need a clear sign on inflation peaking. Hopefully we will get that pretty soon. So the synthetic internal benchmark of ours, which is currently 50% equities, 20% gold, and 30% long-term US Treasuries, was down 5% for the month. Our portfolio was down 6.7% for the month, and the S&P 500, as I have already mentioned, was down 8.4%. So we kind of underperformed versus the internal benchmark in June, but we again outperformed versus the general equity indices, mostly due to the fact that our equity allocation is lowered right now, still between 40 to 50%, on average around 45-46% currently. Equity allocation is around 46%, as I have said. We're still keeping the treasuries longs and the gold longs both underweight versus the current cycle phase benchmark, and we're still having a tiny little exposure to the crypto market via Ethereum. This is a long-term trade, obviously. Risk aversion, risks are on average was 4 and maximum was 6. Risk aversion was kind of kept pretty high in terms of me not adding leverage trades nor hedging. I think that current levels are just too good for most of the equities right now to be actively and aggressively hedging them. So I'd rather stay net long in general. The major reshuffles we have made in equities, we're closing some of the European longs due to the increased fears of recession due to the war in Ukraine. So we've closed BASF, we closed Logitech, and we've also closed the uranium exposure. The major logic behind this was generally just to lower the general equity allocation and rather concentrate on pure exposure to American stocks, given the fact that Europe is much more exposed to the general trends regarding what's happening politically right now in terms of war and all that stuff. We've also trimmed some Morgan Stanley and Garmin. Did just one little hedge throughout the month of June, but generally we were not hedged. As I said, I prefer not to hedge at current levels. Tilt and gold, the exposure was pretty much unchanged versus last month, if I'm not mistaken. But we're staying underweight versus current cycle phase benchmarks in both of those holdings. The cash buffer was bigger than a month ago, between 25 to 35%, and that's why we beat the S&P 500 this month. The long short-term tactical longs in TQQQ and SXPL added some alpha this month, but these were some just short-term trades for very low levels around the bear market's lows in the second half of June. In terms of year-to-date active return, our outperformance versus the synthetic benchmark is 7.3%, and versus the S&P is 8.2%. So we're still outperforming on a year-to-date basis pretty heavily, and the reasons are pretty much the same as every month for at least 6 months right now. So good positioning in the first quarter, hedging in the first quarter, equity allocation generally lowered at the start of the year, and lower than benchmark holdings in long-term US Treasuries and gold. The major market drivers this month, it was generally a very bad month for equities again, right? As we all know, the yields generally kept rising in the first half of the month, only to plunge in the last couple of days. But at the start of the month, there were way over 3%, 3.5, 3.6%, even in terms of the 10-year yield. The macro data continues to support a big slowdown in general. The Atlanta Fed GDP now indicator ended the second quarter below zeros, which technically fulfills the definition of a recession, which is usually 2 quarters in a row of falling GDP, as the National Bureau of Economic Research usually interprets it. But again, this is not a final definition of a recession in US. For that, we need a general macroeconomic slowdown, and this is not usually anyhow related to the 2 quarters of falling GDP. Now the history just shows that it usually is when the NBER calls a recession, it's after 2 quarters of falling GDP. Yet the labor market stays very strong. It's in very good conditions, and the last data that we already saw in July just confirmed that the unemployment rate is at record lows at around 3.6%. There are some soft spots, obviously, in the labor markets as well, but in general, there's been no recession yet ever with such a strong labor market, and that kind of underlines the version that we are not yet in a recession. That's at least what our model is saying, that we're using the enhanced aggregate spread model by Dr. Robert Daly from Northwind Forecast. At the end of June, the fears moved strongly from inflation to recession, stagflation, causing the 10-year yield to slide way below 3% from above 3.5% where it was in the first half of July. Also at the end of June, the major commodities showed further signs of breaking, and for oil obviously is the most important one. The others also kept plunging, so it was a really bad month for commodities. The DJP ETF tracking the Bloomberg Commodity Index was down 12% on month. So yes, the commodities are down, but it's actually a good thing these days, because obviously commodities has been the major driver of supply-driven inflation over the last 12 to 18 months, and we need commodities lower for them to be having a negative impact on inflation on a year-on-year basis in general. So that started happening in June. Quick overview of the Fed. As of May, the Fed was generally still acknowledging that they won't hesitate, and investors generally felt like they're currently anticipating a series of half-point hikes, and the market was reacting appropriately. In general, we had the FOMC meeting on the 14th and the 15th of July, and we got a hike of 75 basis points, which is pretty much unprecedented in like 40 years, I think. Funny thing about this is that the market consensus was rather around 50 basis hike, but we got that nasty CPI data, which kind of spooked the markets, and the Fed first in a controlled way leaked a 75 basis points hike, and then they actually delivered a 75 basis points hike at the meeting, basically making ground for another 75 basis hike on the next meeting as well, obviously still being data dependent. Quick look at the inflation tendencies in general. We've got 12 out of 18 major GOGs higher this month versus last month, versus 8 in May. So actually, as the last CPI readings confirmed, the situation confirmed that there's no inflation peak happening just yet, and that's why the Fed had to come up with a very, very aggressive move of 75 basis point hike at the last meeting. Commodities in general, as you see here, are finally softening on year-on-year terms. July looks much better than May. As you can see here, in June, oil is up 40% on year-on-year basis, and it was down almost 80% in May on a year-on-year basis. And the same thing pretty much applies to most of the major commodities, including natural gas, which had a pretty big plunge in June. As you see here, it was up 180% year on year. In May, it's now up only 64% year on year. So these things are generally good things for the market in current circumstances, and I think investors should generally welcome these happenings. And this also shows that the Fed policies are starting to finally bring their expected results. In terms of forecasts and expectations, we're still in the boom phase. We're watching the coincident indicators pretty closely right now, but all of them, but for one, which is the S&P, are still in the boom phase. Only the S&P is now down year on year. In the expansion phase, sorry, only the S&P is now down year on year, which is the boom phase. But private payrolls, industrial production, and generally speaking, the delta, which is the difference between the year-on-year dynamics of the S&P 500 and the short-term unemployment rate, is still very, very positive, up 36%. So in terms of views and conclusions, I'm not changing my views in general from last month. In terms of positioning, it's pretty much the same as it was, and in the upcoming weeks, I do rather not plan to make many moves in these terms. I do think that equities are generally extremely oversold, and now we've seen a general fall in the PEs, which was driven basically by prices. But right now, the next move is going to be, the next big move is either going to be up or down when we get a confirmation, or the market consensus gets kind of a general feeling that we're either out of the woods for now, and we're not in a recession, or we are in a recession. Obviously, in terms of getting the latter version of those two, there will most possibly be a big change in the forecasted EPSs by the market consensus, which will obviously drive the PEs higher again, and the general market most possibly lower, right? Because the prices will have to adjust lower for the PEs to become acceptable again. But anyway, for now, we're trading at around 16 times PE for the S&P 500 in terms of 1-year forecasts, which is already below the average long-term for the index, which is at around 17 times. Yeah, that's about it. I think in general, I do expect summer to be more calm. After the next meeting this month, the FOMC will most possibly want to see the effects of their work lately. They're starting to see commodities falling, which I think they welcome a lot, and they will want more of that for the general price pressures to be confirming to calm down, for them to let the equity markets kind of breathe a little bit. So I think June, July and August, sorry, are going to be a little bit more calm, but obviously as we start the autumn, the things might get ugly again, and the volatility might continue. So thank you very much for this month. Please always remember to be patient and resilient through turbulences, which we're facing right now, as you can see. Thank you very much, and I'll see you in a month. Thank you.